Women Plus Real Estate. Real estate insight for decisive, intelligent women who learn, rent, own, invest, and live with intention. Here's what's happening this week. A real estate market for this week, that's February 8th through the 14th, 2026, that effectively defies, well, Economics 101. It really does. We are looking at, usually when your sales volume drops almost 9%, you'd expect prices to follow right along. They haven't. Not at all. And usually when vacancy rates hit, decade highs, you expect that investment capital to just dry up, and it hasn't. It's a moment where all the traditional signals are just flashing conflicting colors. Yeah, exactly. You have cooling metrics right there on the surface, but then underneath, things are really heating up. So today, we're breaking down Eve Moss's latest market intelligence report from Women Plus Real Estate. And the thesis here is a bit uncomfortable for a lot of people. The confusion in the data isn't a bug, it's the feature. The whole premise is that if you're waiting for the headlines to make perfect sense before you act, you have probably already lost the trade.
Right.
Moss calls it opportunity and complexity. And I think that's the perfect mental model for this deep dive. When the market is obvious, think back to 2021 when everything was just up and to the right. You pay a premium for that clarity, a huge premium. But right now, the market is messy. And messy usually means mispriced. Exactly. And we're not just talking about high-level theory here. Whether you're renting, buying, or investing, the actual rules of engagement shifted this week. The data suggests we're seeing a structural change in leverage that I think most people are missing. They're missing it because they're too focused on those cooling headlines. The headlines say slow down, but the data says power shift. Okay, so let's start there. Let's start with that power shift in the rental market. I was looking at the Zillow data from the report for November 2025, and the concession numbers are just staggering. Nearly 40% of all rental listings are now offering concessions. The specific number is 39.3%. And just to put that in perspective for everyone, in 2019, which was a pretty normal market, that number was only 14.4%. This is the highest share of concessions Zillow has ever recorded. And we should probably be really clear about what concessions even means in this cycle. This isn't about, a free tote bag or a waived gym fee. These are significant financial incentives. We're talking 2 months free on a 14-month lease, waived deposits, parking thrown in, things that really affect the bottom line. Exactly. No, it's a defensive crouch by landlords. And to understand why they're doing it, you have to look at the supply pipeline. We are still feeling the aftershocks of that huge construction boom from 2023 and 2024. I mean, developers added over 700,000 apartments in 2024 alone.
Yep, right, a 40-year high?
A 40-year high. And even though we know construction starts dropped off in 2025, real estate has such a long lag time. A tower that was started in late 2023 is just now opening its doors. And that inventory is just flooding the system right now. Exactly. CoStar Analytics is forecasting that vacancy rates are going to hover around 8.5% all the way through the end of 2026. And in the multifamily world, 8.5% is a very, very painful number for an owner, which completely changes the landlord's psychology. They're moving from, say, yield maximization, trying to push rents up, to occupancy preservation. Yet they just need bodies and units to cover their debt service. It's a perfect way to put it, precisely. So if you're a renter, you are no longer just a customer competing for a scarce resource. You are a lifeline to their net operating income.
So the actionable insight here for you, the renter,
is to stop acting like it's 2022. If you just sign your renewal letter at whatever rate they send you, you are absolutely leaving money on the table. You have to negotiate. You have to. And you need to be specific. How so? Well, Eve Moss outlines a few tactics in their report. Don't just ask for lower rent, ask for 2 months free up front. Landlords often prefer that because it lets them keep the face rent high in their books. Right, which looks better to their lenders. It looks much better to their lenders, even if the actual cash they collect is lower. It's a win-win. It protects their asset value while saving you, the tenant, a lot of cash. The report also mentions negotiating for flexibility, right? This is huge, especially if you think you might want to buy a home soon. Ask for an early termination clause without a penalty. In a market with 8.5% vacancy, a landlord would much rather have you for 6 guaranteed months than risk an empty unit.
So you use that leverage to buy yourself
Some optionality. Buy yourself optionality. I like that. Yes. Okay, now speaking of buying, let's pivot to the residential housing market because this is where the psychology gets really, really interesting. We have this paradox where affordability is objectively getting better, yet sales are tanking. It creates a strange kind of cognitive dissonance. The National Association of Realtors reported that existing home sales fell 8.4% in January 2026. By all accounts, that looks like a market that's just freezing up. But then, at the exact same time, Zillow reports that affordability has improved for 7 consecutive months. Your typical monthly mortgage payment is roughly 8% lower than it was a year ago. So it's cheaper to buy a house today than it was last year. Yet fewer people are doing it. What's going on there? It's recency bias, and it's combined with fear. Buyers are sitting on the sidelines, completely paralyzed. They're anchoring their expectations to the 3% interest rates of the pandemic era, the anomaly, yeah. Or they're waiting for some massive price crash that just hasn't materialized. The anomaly, yeah. It's so ironic because if you rewind to 2021 or 2022, every single buyer I talked to was miserable. Oh, absolutely miserable. They were complaining about the competition, waiving inspections, writing these love letters to sellers, which was, let's be honest, a symptom of a totally broken market. A broken market. They were getting into bidding wars with 20 other people. They begged for a market where they could actually inspect the plumbing, negotiate on the price and not have to make a decision in 15 minutes. Well, that market is here. It arrived this week, and now that it's here, those same buyers are afraid to act because the headlines say sales are down. So the lack of sales volume is actually the opportunity. That's the trade-off. It is. You can have the lowest rate in history, but you will have the highest competition in history. Or you can have a normal rate like we have right now and basically zero competition. You almost never get both. And when you have zero competition, the whole power dynamic just flips. You can ask the seller to buy down your rate. You can ask for repairs. You can negotiate closing costs. Exactly. The report really emphasizes that while everyone is reading sales drop 8.4% as this huge warning sign, the contrarian reads it as competition drops 8.4%. You might be the only offer on the table. All of it. That is a position of strength that buyers just haven't had in years. But it requires the stomach to act when the rest of the herd is standing still.
Which brings us to the group that is famous for acting when the herd is still, institutional investors.
The smart money. This part of the report really stood out to me. While individual buyers are scared, institutional capital is just pouring in. MSCI Real Capital Analysis shows these large funds moved $165.5 billion into multifamily properties in 2025. Which is up nearly 10% from the previous year. It's a massive divergence. Main Street is scared, but Wall Street is buying. But I want to push on this a little bit. If we just establish that rent growth is stalling and vacancies are high, why on earth are these sophisticated funds dumping billions into the sector? Are they just buying the dip? It's partly evaluation, sure. Prices from multifamily assets did drop about 1.3% in 2025. So they are getting a bit of a discount, but the real driver is their time horizon. A pension fund or an insurance company isn't trying to flip a property in 12 months. They're looking at a 10-year horizon, maybe longer. Okay, so they can afford to just ride out the supply glut we were talking about earlier. Exactly. They know that the construction slowdown happening today means a housing shortage 3 years from now. So they're buying the asset today to own the cash flow in 2030. They're underwriting conservatively and they're just waiting. And that leads to a really critical warning in the report for the individual investor. The listener who might be thinking about buying a duplex or a fourplex right now. You can't play the same game as the institutions, but you have to respect the data they're looking at. All right, this is the sort of danger zone for the BRRR strategy investors, or really anyone who got used to the easy money over the last decade. The report is very explicit. Do not model your deal assuming 3 to 5% annual rent growth, which was the standard assumption for years. You just plug in 3% growth and the spreadsheet would turn green. That era is over, for this cycle anyway. CoStar is predicting that rent growth is going to average just 1.5% annually through 2030. That barely keeps up with inflation. So if you're buying a rental property today, it absolutely has to cash flow day one. 100%. You can't bank on future appreciation to bail you out of a bad deal. No, this is a cash flow market, not an appreciation market. The advice from Eve Moss is, and I'm quoting here, don't use this market to learn by doing. Yeah, if your deal relies on raising rents next year just to break even, you have to walk away. The structural headwinds, things like lower immigration, slower household formation, they are all putting a lid on rent growth. Ouch. So conservative underwriting is the only way to survive? If the numbers work at 1% growth, buy it. If they don't, let the institutions have it. Let's talk about the math of waiting, because this applies to both the homebuyer and the investor. The number everyone is obsessed with is the mortgage rate. It's the headline number. As of February 12th, 2026, the 30-year fixed is hovering at 6.09%. That's a 3-year low, but I still hear people saying, I'm going to wait for it to hit 5%, or I'm waiting for the 4s. And the hard truth is those people are very likely making a big financial mistake. First of all, the 3 or 4% era was an anomaly. It was a global emergency response. The 50-year historical average is closer to 7 or 8%. So 6.09% is not high. It's actually a historically healthy rate. But let's look at the cost of equity versus the cost of debt. If I wait for rates to drop to 5%, what happens to the price of the asset? That's the trap. That is the trap right there. Low rates are effectively a liquidity injection into the market. If rates drop to 5%, all that pent-up demand we just talked about comes flooding back in. And prices spike. Prices spike. So you might save 100 basis points on your loan, but you end up paying 10% more for the house. You're trading a monthly payment win for a net worth loss.
Exactly.
You're paying a higher principal for a slightly cheaper loan. And while you were waiting, you were paying rent, which has a negative 100% return on investment, and you missed out on all the amortization you would have gained by owning. And you're right back in a bidding war. You're back in the frenzy. The report argues that 6.09% combined with low competition, that's the sweet spot. It's the window where you can actually control the transaction. And there's also a life cost to waiting that, it doesn't show up in the spreadsheets. That's the most important variable of all. Waiting for a perfect market implies putting your life on hold. It means delaying stability. At a certain point, the utility of just owning the home and living your life has to outweigh the gamble of trying to time the bottom of the rate cycle. So let's synthesize this. We started with this idea of a market paradox, all these conflicting signals. But when you really strip it down, the confusion is just a cover for opportunity. That is the big takeaway. When the market is obvious, it is expensive. When it's messy, like it is this week, that's where value is created. So for the renters listening, the data is on your side. 40% of listings have concessions. Be aggressive. You are the asset that the landlord needs to stabilize their entire portfolio. Don't let the headlines scare you. Low sales volume is your friend. It means you can buy without the hysteria. Lock in the 6.09 and sure, refinance later if you get lucky, but don't bet your future on it. For the buyers out there and for the investors out there. Forget appreciation. Look at the yield. If it doesn't cash flow with 1.5% growth, it's not a deal, it's a gamble. And you should let the institutions play the 10-year game while you focus on solvent cash flow today. The final thought from Eve Moss is really about risk tolerance. The quote-unquote perfect market feels safe because everyone is doing the same thing, but alpha real return is only found in the mess. If you're waiting for the headlines to tell you it's safe to buy, you're really just providing the exit liquidity for the people who bought today. Exactly. The door is open, but you have to be willing to walk through it alone. That's where we'll leave it. Don't fear the complexity, use it. That's this week from Women Plus RE. Full newsletter with data, links, and archives at womenplusre.substack.com. Until next week, keep your eyes on the market.